Now I want to demonstrate a concept called co-movement. And what I have on screen right now is a graph of the Dow Jones Industrial Average for the past decade. And you can see it rises, it falls. This was at the end or early 2009. The market had dropped a lot over the last, from 2000 October of '07, and it fell fairly steadily with a couple of small jumps, and then bottomed out in February of 2009, and has, generally speaking, risen since then, although it's had some little drops in the last few years. And so what I want to do is just compare the Dow to the S&P 500 just to see how closely they mimic each other. And you can do see and do see you can see that they do move together. And like shoot, I don't really want to leave this page, but I don't see what I'm. Oh, here they show a couple. This is the Nasdaq Index, and this is the Dow Jones, and I wish they were showing the S&P 500 right here as well. But you can see like both of these indexes fell today, and I actually am gonna go ahead and open in a new tab and go look at it. So you can see the S&P 500 fell today as well, but it didn't fall quite as much as the Dow did. And the Nasdaq fell worse than either the Dow or the S&P 500, but all three indexes fell today. So this is a measure of the broad US market. This is a very narrow measure of large cap, or actually giant cap companies in the US. This is a measure of smaller companies, generally speaking, but not necessarily. It's also fairly heavily weighted in the technology sector. So, but most, I think all those companies are U.S. based as well. So no foreign markets are captured by these three indexes. But at any rate, all of or the two that I have, the Dow and the S&P 500, move fairly closely together. So when one index dropped here in September 1st of 2011, the other one had dropped as well. And like when the market crashed, when the Dow crashed in 2008, so did the S&P 500. It's possible to I actually typed all this and recorded a video, but it got lost somehow. But it's possible to measure co-movement through a statistical term called correlation. And I don't need y'all to know how to measure it, but I would like for you to have a general understanding of what a correlation number means. So correlations are bound by +1 and -1. A perfect 1 that's positive means that the two securities move always in the same direction by exactly the same magnitude. Now, when I go and look at, oops, when I go and look at the S&P 500 and the Dow, they do move essentially always in the same direction, but they don't move by the same magnitude. Sometimes one index will drop by the more than the other, or rise by more than the other, and you can see that from these percentages right here that I was discussing earlier. The They're bound in the other direction by -1. -1 means the two securities move perfectly, always in the opposite direction by the same magnitude. So when one security generates a positive return, the other security generates a negative return. And they would generate opposite returns of the same magnitude. That's incredibly rare. It's possible to find securities with very high correlations, very close to +1, but perhaps not exactly a perfect +1. Like I've calculated the correlation between the S&P 500 and the Dow, and it's about a 0.98. So it's awfully close to +1. But most securities, most stocks in the United States have correlations that range from zero point 0.3 to zero point 0.7. That means they tend to move in the same direction, but they don't move perfectly in the same direction. And I'm gonna, this idea just popped in my head. while I was sitting here recording this, and I don't know how well it's going to pan out, but I'm going to just pop a couple of securities up here for, let's say, 5 years. Maybe I can get it to 10 years. Here we go. So here's Ford, and I'm going to compare Ford to, I don't know, GM. Oh, and that's right, GM declared bankruptcy and their stock truck stopped trading for a while, but it restarted eventually. So they're not here for the whole time period. But you can see that they do move in the same direction as Ford. When Ford was having a big drop here, so was GM. But they don't move perfectly together. And I'll add, I'm going to add Volkswagen just kind of for fun. So here's Volkswagen, and you can see Volkswagen moves quite a bit differently than Ford or GM. Well, GM isn't here for on the graph for this time, prior to here, but Volkswagen was having a really volatile time back in '08. That's really interesting. Had a huge peak and then a huge drop. It would have been nice to have bought it essentially here and sold it right there, but I don't know what was going on with Volkswagen at the time. But then Volkswagen's having trouble right now because of their emissions crisis, I guess I'll call it. Ford and GM aren't having that difficulty, but you can still see there was a little drop in Ford and a little drop in GM right there, but a huge drop for Volkswagen. And I'm not going to add another company that's not a car manufacturer. I will add, oh, I don't know, Costco. So here's Costco. And, since Costco's in a different industry, it's not going to move in exactly the same way as the car manufacturers are. But you may see some positive co-movement. I think that one might be hard to discern here. So what I'm getting at is not all companies move really closely together, but they don't necessarily move in the opposite direction. There's going to be a variety of co-movement when you combine different companies and indexes. So I've only put companies here, but if I were to put different indexes, you'd see a variety of co-movement as well. And I'm gonna pop back to here, and I'll go and look at the S&P 500, and I'll go out to max. And what I'm going to do is compare the Dow to it. And I don't know if I can. Sure, it would be nice if I could just drag this, and it would narrow in. I'll just click here and go. Actually, the last 10 years won't show it. Sorry. I'm, I I thought, oh, there is. Here we go. I think this lets me zoom in. So this is actually a good time period because it includes the time period for the Nasdaq that I want to show you. So what I'm going to do is now pop in the Nasdaq. So you can see the Dow and the S&P 500 are moving closely together. I'm going to pop in the Nasdaq, zoom in again, and you can see the Nasdaq, the green line, um, moves a bit differently than the S&P 500 and the Dow. So here was a drop for both the S&P 500 and the Dow, a drop for the Nasdaq. But look what happened over here. This was when the dot-com businesses were booming in the late 1990s and in 2000, and then into early 2000 or late 2000, early 2000s is what I meant to say. There was a dot-com bust, and so the prices of a lot of dot-com companies started dropping, and that's reflected here. Remember, I had said the Nasdaq Index is fairly heavily weighted in the technology sector, and that's what causes this huge blip in late 90s, early 2000s. So these indexes do kind of move closely together, but not perfectly. But they do move positively together. So if I were to calculate their correlation, it would be a positive correlation, but not necessarily a perfect plus one, or maybe not even above a point 0.8. And that's actually exactly what I did here. So I have all 10 indexes. And in Excel, there's actually a function that lets you calculate the correlation. So I crunched it for all 10 indexes relative to each other. And like we'll look at the Europe, Australasia, and the Far East index relative to the Barclays Aggregate Bond Index. So this has a negative correlation of 0.36. But the Russell, let's look at the Russell 2000 value versus the Russell 2000 growth. That's the intersection of here and here. So the Russell 2000 value is on this row, the Russell 2000 growth is on that column. So where those two intersect is how these two indexes co-move or correlate with one another. So they correlate positively and fairly highly together of 0.66. But the S&P 500 value and the Russell 2000 growth actually correlate more closely together, closer to zero point 0.1. And we're not after a perfect plus one correlation. That's actually about the worst correlation you can have. We're actually after lower correlations, because the lower the correlations, the more risk reduction we'll get. The more, like when one index does poorly, another index will do better and it'll balance out the risk. So we would prefer lower correlations compared to higher correlations if everything else were equal. And here the S&P 500 value and the S&P 500 correlate very highly together. And I'm kind of curious of to see the S&P 500 and the Russell 2000. So that would be here. So this is a small cap index. This is a large cap index. It's a mix of value and growth. And so they correlate fairly closely together with 0.85. And you'll notice that the aggregate bond index is the only one that has negative correlations. So essentially, bonds tend to move in the opposite direction or have negative correlation with stocks, because all of the rest of all of the indexes in this list that I have highlighted are equity indexes, except the two orange ones, which are bond indexes. So negative correlations with all those equity indexes, that one as well. Here is the Barclays aggregate against the Barclays high yield corporate bond index, and it has correlation that's essentially zero. So, not all asset classes, which again is what these indexes are essentially measuring, not all asset classes co-move positively, or even if they do co-move positively, they don't necessarily co-move highly positively together. That means we can benefit from forming portfolios that low or even negative correlation can help reduce our risk. So long as the correlation is less than 1, we benefit. We'll benefit more if the correlation is negative. So what I have done is, I don't actually have it open, but you don't need to see it. I have written some programs in Visual Basic for Applications, VBA, which is a programming language that Excel uses, and I told it to look at the return these different indexes generated, look at how risky these different indexes were, look at how they move with each other, and go through and find a way to weight or combine those different indexes to get risk to be as low as you possibly can without sacrificing return. And that's what these green dots are. So, for instance, let's just talk about the Europe, Australasia, and the Far East index. That generated a return of 7.18%. But it did it at the cost of high risk, 20.54%. Well, over here, I see that if I had, now I know that's not telling you a whole lot of information, but it is telling me the return and risk numbers, and I just need to look at something down here. Point B generated slightly better return than the Europe, Asia, Australasia, and the Far East, which only generated 7.18. B generated 7.29. But look how much lower risk is for point B. Risk is 4.19%, where over here risk is 20.54%. This point has what, 5 times the risk as point B. And to top it off, point B actually generated better return. So what I have done is optimized a weighting scheme to generate the best possible return that the program could figure out to accomplish this return right here. So let's go see what it recommends for point B. That information is here. And sometimes you'll see a 0. Actually, I'm going to scoot this over just a bit. So here's the risk, here is the return for point B, and then the values in the highlighted area represent the weight that you should put in each index to accomplish point B. So remember how I said the equally weighted portfolio was a naive portfolio? Just putting 1/10 of your money in 10 of those different indexes is really naive. There's not necessarily any benefit to having some money in some of those indexes because they move together really positively and you're not getting any significant risk reduction. The numbers in this section are not naively calculated. They are optimized weights calculated by the programs that I wrote, specifically trying to figure out the best possible weighting scheme that will get risk to be as low as possible while maintaining return, creating what I call dominant portfolios. So the dominant portfolio or the weighting scheme that accomplished point B was to put about 83% of your money in the Barclays Aggregate Bond Index, 5% in emerging markets, 8% in the Russell 2000 value, and 4% in the S&P 500 growth, and then nothing in any of the others. But not all the weighting schemes look like that. Let's look at point D. Point D is a riskier position. It's going to result in risk of about, actually D, 8.5% compared to risk of 4.19%. So it's about twice as risky. But the trade-off for that extra risk that you'd be taking is it would have generated you higher return, 9.29% versus 7.29%. So it would have generated 2% more return. How would you have needed to have weighted your indexes to accomplish point D? You would have had to put about half of your money in the Barclays aggregate, 3% in emerging markets, about 32% in the Russell 2000 value, and about 15% in the S&P 500 growth. And point G would have required an entirely different weighting scheme with most of your money in the Russell 2000 growth. Whoops, that's going to pop you, what did I say? That was point G. That's going to pop you way over here. So 9.29% in terms of expected return, or actually return, not expected return, but risk of 16.8%, which is, gosh, twice as much as point D's risk. So all these green dots are, oh, actually not all of them, but B through H are what I call dominant dots because there aren't any better points. But if I look at point A, which happens to also be 100% putting 100% of your money in the Barclays aggregate, it's not a dominant point because B would have done better. It would have generated higher return with slightly less risk. Now, that's the benefit of allocating assets across different classes, some small caps, some large caps, some emerging markets, etc. Now, I'm using perfect hindsight. I know exactly how these 10 indexes co-moved with each other over the past 2 decades. That doesn't mean that they'll co-move this way over the next 2 decades. So these numbers for the future are not known. nor are these numbers. These are the returns they actually generated for the past 20 years. I know that this happened, but I can't know what return they definitely will generate for the next 20 years. So I can only estimate. And based on my estimates, decide how to allocate my money across different asset classes so that in the future I will hopefully achieve a dominant point. That's my goal. There is not one dominant point, and remember only points B through H are dominant. There is not one dominant point that's perfect for everyone. Some people might be quite comfortable taking, I'm just going to highlight like this. Might be quite comfortable taking risk in this range, but other people might be very uncomfortable with that and they would prefer risk that falls in this range. So they're moderate risk takers. But there might even be other people who are even more risk averse and they want their risk to fall in this range. So they would only want points B and C. Other people might be willing to go with D, E, and F. And other people, the real aggressive risk takers, would go with G or H. And there are different weighting schemes for each of those green dominant points. Uh, Here's hoping I could find that fairly easily. Paul Merriman is a he actually went to Western and he graduated, gosh, 50 years ago or so. He then went to New York and worked on Wall Street for a while, and then he retired and moved to, I think, Seattle, and opened up an investment advisory business and worked at that for a while. But now he's retired again, and he spends his time educating people. So he writes this article called Market. Well, he writes on this website called Market Watch, and what he has done is for different investment companies. So far, he only has three, but I think he's working on adding more. He has generated some recommendations for how you should allocate your assets across different index mutual funds, depending on whether you're an aggressive investor, a moderate investor, or conservative investor. So, like, I'm going to zoom in a little further. For instance, if you're a if you're a conservative investor, he recommends more bonds. So he's got here these treasury mutual funds are his bond ones. These are also bond ones. So he's got a high percentage in those. But if you're an aggressive investor, he says don't put any bonds in your portfolio. Instead, focus on basically large cap value, small cap value, real estate, developed markets. He's got some emerging markets down here. He's got a decent amount in emerging markets. Um, and these are foreign. He doesn't have that much in foreign, which is kind of interesting. I might put a higher weight in foreign than he does, but these are just his recommendations for what he believes will create essentially a dominant point on average in over the long run. For and again, there's not just one dominant point. He's got three dominant points that he's believing will accomplish basically 3 points on this graph, three dominant points. So that's the idea behind asset allocation. You shouldn't put 100% of your money in one thing because low correlations, low co-movements will allow you to benefit from risk reduction and still maintain your return.